Okay, let's start at the very basics. What a fair value gap is. It's a 3-candle formation. We have candle 1, candle 2, candle 3. This is a bullish fair value gap. First candle, we're looking at the high. Then we have a second candle and then a third candle. What we're looking for is the third candle not to overlap the first candle's high. Okay, you can see that this first candle's high is here. We then have the second candle, and then we're looking at the third candle, and we do not want this candle to overlap this candle here. This validates this as a fair value gap. Also known as a BISI, buy side imbalance, sell side inefficiency. And what this means and how ICT likes to explain it is the paint roller analogy. Paint has been applied in one direction, but price is only being offered on the buy side. So it's a buy side imbalance, sell side inefficiencies, inefficient in its sell side, which leaves this gap, this buy side imbalance, sell side inefficiency. What this means is we can utilize this space as an area where we are anticipating price to fall back into before expanding higher. Now, what's worth noting is as follows. It's that fair value gaps, like wicks, are gaps. We have upper quadrant, which is 75%. We have consequential encroachment, which is the 50% equilibrium. And we also have the lower quadrant, the 25% level. Now, technically speaking, the fair value gap isn't balanced until the low has been hit. But there are certain circumstances when we can anticipate upper quadrant or consequential encroachment to be tagged before price moves higher. One of the reasons why we may get that is institutional entry order drills, and we only just wick into this fair value gap before moving higher, and sometimes this will enter a buy program. Now, this is a topic for a later date, but just know if price is very bullish and it's looking to expand into a higher premium quickly, then we can look at the upper 25% as a potential entry for price to move higher. And in the bearish example, it's a 3-candle formation, albeit we're going in the opposite direction. These are red candles. This is a bearish fair value gap. This is a SIBI. So this is a sell side imbalance, buy side inefficiency. So price is only being offered on the sell side and it hasn't been efficiently balanced on the buy side, okay? And we're looking at the low of the first candle and the high of the third candle. At no point has the third candle overlapped the low of the first candle. This validates this as a SIBI, sell side imbalance, buy side inefficiency, fair value gap. And the same premise applies with regards to quadrants. We have consequential encroachment, we have the upper, and we have the lower quadrant. If it is looking to expand lower very, very quickly, we can anticipate the lower quadrant to be filled before moving lower. If we're expecting price to run a little bit deeper, we can anticipate consequential encroachment to be hit. Technically, this isn't fully rebalanced until price has filled this fair value gap, okay? Now, what we could look at is for anticipatory skills for understanding whether price is likely to fill the lower quadrant or the upper quadrant is look to see where this SIBI forms within inside of the range. If this SIBI, for example, is within inside the equilibrium of this range, we can anticipate price to run slightly deeper, getting into an OTE of the range before moving lower. Let's break down this piece of price action here. And this is when we could start utilizing a fair value gap as an entry model. And we'll break down what we've just been through in the previous slide. We are looking at this piece of price action here, and this price action has run down into a PDRA where we're anticipating price to move higher. So price is within inside of a discount of a previous range, and we are looking for price to expand higher to go and fill in inefficiencies and imbalances in price inside of a premium, okay? Now, this is where we could start utilizing a fair value gap, and we have one here, okay? We have the candle 1, candle 2 and candle 3, and you can see at no point does candle 3 overlap candle 1, okay? So we can just quickly mark these out. And what does that leave us? That leaves us with a BISI, buy side imbalance, sell side inefficiency. Now, what I was mentioning to you previously, these have quadrants, right? And technically this BISI is not filled until price has fully overlapped candle 1. Okay, now when was I saying that this is more likely to happen? Well, it's when we look at the range that it's in and we're anticipating price to get into a short-term discount before moving higher. So we had this BISI here. We could have looked at the upper quadrant, but if we'd taken the upper quadrant, we would have still been inside of a premium of this range here. Because this range equilibrium is a fill of this BISI, we would anticipate price to come and fill this BISI before moving higher. Okay, this is an example of when we are getting a full rebalance of a BISI before price expands higher. Now let's have a look at a sell side imbalance, buy side inefficiency, so a SIBI. And here in this example, we have a very classic 2022 model where we have a purge on the buy side. We have a market structure shift, return up into an OTE. I'm not going to go through a 2022 model, that'll be for a later session, but this is candle 1, this is candle 2, candle 3, and at no point has candle 3 overlapped candle 1, which leaves us with a sell side imbalance, buy side inefficiency. Now, what we can look at here is the width of this fair value gap, right? And what I would like to do is place a quad fib over that SIBI, right? And I'm combining a couple of things here now, right? We have the quadrants that I was mentioning before, the lower quadrant, consequential encroachment, 75%. This is an example where you would anticipate price to run deeper into this SIBI to rebalance it before going short. Right? It's not fully rebalanced, but you could anticipate price getting up to this 75% in conjunction with the fact that if we place a standard fib across this range, we are technically inside of a short-term premium. Anything over equilibrium of a range is a premium. Okay, if price is therefore looking to move lower, we can look at a entry inside this SIBI inside of a premium, and that coincides with 75% of that SIBI. And look what price ran to a tick before moving lower, right? The upper quadrant of this sell side imbalance, buy side inefficiency. Now, what's worth noting, and this is really, really important, is this has left the door open, okay? And what I mean by that is this isn't fully rebalanced. Therefore, if I'm expecting price to make a wider move lower, I'd anticipate this SIBI to get filled in, right? You want price to be filled in and SIBIs to be rebalanced before price moves low. So this has always left the door open that price could move up to fill it. So if we just move price along, we can see eventually what happens. This is the same sell side imbalance, buy side efficiency that's being referenced at a later date. And you can see in this example, price ran up into this bearish order block, which happened to be candle 1, completely filling in this SIBI, running up into 62% of this range before selling off. Okay, so just bear that in mind. If a SIBI has not been fully rebalanced, we can anticipate price moving up into that before moving lower, especially if the candle above it is an order block. Because if we go through our PD matrix, we know that we have an order block, then a rejection block, then an old high. This order block is protecting the SIBI above it. Now here's a bonus, and it's inverted fair value gaps. And what we're looking for me personally is fair value gaps, so SIBIs or BISIs around swing highs or swing lows. Now we're using SIBIs at pivot highs when we're expecting price to move higher. And this is an inverted SIBI, which was once acting as resistance turned support. And this anticipating price to expand higher and take relative equal highs and move up into a premium. We can therefore target a SIBI below a pivot high. So now I would be looking to place my entry at the low of this SIBI with my stop on the other side. And this is an inverted fair value gap. This is an inverted SIBI. Now, if price were to fail this SIBI, we could anticipate price to move lower, either back into an OTE of this range for a retest of it, or we can anticipate price to draw down to tackle the lows, depending if price is within inside a premium, looking to run into a deeper discount. But in this example, price was looking to run into a deeper premium, and that's when we could use this as an inverted fair value gap, an inverted SIBI, okay? So if you have any questions or comments, feel free to let me know in the below. But as always, if you like this video, please do consider smashing the like and subscribe. And until next time, trade safe, trade smart, and I'll see you on the other side. Take care now.